Well, good morning and welcome everyone to the Experian Quarterly Business Credit Review for Q3 2024. My name is Gary Stockton. I work here in marketing at Experian with Brody. Before we get underway, I just wanted to mention a couple of things. If you would like to follow along, we've dropped a PDF of the slides in the handouts area. You can just hit that QR code there in the upper right corner if you've got your phone handy, or go to that short link there that we've got on screen. We'll also include a link to the slides in our follow-up emails, which you will get tomorrow. So if you don't want to bother with that, you can just wait till tomorrow. You get that, and a copy of the recording as well will go onto our YouTube channel. During today's webinar, we're going to be discussing key findings from the latest Experian Main Street report for Q3 2024. You should all have received an email from Experian announcing the release of the latest report. Our follow-up will include it if you do not already have a copy of the latest report. Our presenter today is Brody Oldham, Vice President of Commercial Data Science. Now, Brody heads a team of statistical consultants, scientists, and modelers and engineers, and they deliver advanced analytic solutions, services, and actionable data visualizations to clients. He also represents Experian as a speaker and writer on credit market trends. As always, we encourage you to submit your questions using the Q&A applet in the tool panel. We'll try to leave some time at the end to answer those. If not, we will route those to Brody, and we will be responding to those in the coming days. And now I would like to turn things over to Mr. Brody Oldham. Brody.
All right, thanks, Gary. And welcome everyone to our fourth quarter of 2024. And I hope you are all excited as we close out the year. It seems like a pretty good ending to an exciting year. As I'm sitting here in Texas, prepping for Christmas and getting into that headspace, I stumbled across a couple of my presents this week. And I always look at them and say, all right, how does my family feel about me? I saw a package of dad jokes, which made me laugh. And I wonder, do they think I'm really that funny? So I'm excited to dig into those as we sit around as a family, get a little time. And I hope you get a little time too, as we get into the next couple weeks here to close out 2024. So the way that I stand back and look at what's happening around the world to see how small businesses are going to interact over the next year. We've had an exciting final fourth quarter here as the elections closed out. We have a new administration on the way, and certainly some challenges across the globe that will impact supply chains as we go forward. Put a few risks here that I see as we're getting into the early part of next year. Some of those are already impacting us through the third quarter and into the fourth quarter. I mean, the biggest news this week has to be Syria, with Mohammed al-Bashir taking on the new government there in Syria. Some vacuum in the way that the country is working that has some adjacent players certainly in the region that could be challenging to supply chains as we go forward. So we'll continue to watch that situation in the Middle East as we go forward. Of course, we have the South China Sea, a lot of production in Taiwan, still areas of challenge within China as we look at their economy, looking for opportunity to kind of pick back up. We looked at commodity prices this week, pick up a little bit more as China put a little more influence toward construction, home, residential, and commercial construction projects that have been in the mix and really the target of most of the news out there. We look at Ukraine, Zelensky certainly coming back in the past week or so as we're entering this new administration here, U.S. stateside. Countries around the world are making already some plays as they're expecting some just different policies from an international perspective as we get into the next few weeks into the inauguration time period for a president-elect as we go forward. So Zelensky looking to join NATO versus really trying to take back some of the area there. Conflict could end soon. We've seen a little bit of challenge with some of the commodity prices and food prices coming out of that region. So we'll look for some relief there as well. Europe is still challenged as we look at economies compared to the US. Germany, certainly France, having some challenges this week. Eurozone still not competing with, or still having a difficult time. And so when we look at the US economy versus the world right now, we're really the place for investment as we go forward. So as we look at risks that are out there, I think you can see a few of those just from a general perspective from a global, but when we look domestically, the other things that you'll see here, certainly from an infrastructure perspective, we look for additional funding that'll come in for construction on roads, bridges as we go forward. We'll look for regulatory changes. Certainly the CFPB has been putting in new and additional rules or expectations for rules before the end of the current administration as they look forward to how they'll be positioned over the next 4 years. So certainly Chopra has been moving that agenda forward. So we'll see how rules like 1033 are impacted as we get into the next year, which will impact some of you, certainly as we look at oversight from that agency onto lending and data collection as we go forward. So some of you may be thinking about those positions that you're in and what type of data you need to collect. Certainly Experian has been thinking about that wholeheartedly as we've been looking at this over the past couple years. Tariffs are a big news story that's out there. There are a few things. Certainly, we've seen Trudeau come into the U.S., meet at Mar-a-Lago. We see the Mexican government also looking at tariffs just locally between 20-25% potentially just with our closest borders that can impact certainly transit coming across. Immigration is kind of a main concern of the administration, and so this could be used more as a bargaining tool. And I think positioning across the North American continent is certainly happening now. But as we go forward, that can cause some volatility as we look into the next 6 months. So I think everybody is positioning for the new administration coming in. We'll see energy policy shifts with some of the new cabinet that's coming into, and certainly with the Doge as well, led by Musk. We'll see some challenges there as we go forward. Some conflicting interests in there, but as we go forward, we'll continue to watch that and see how it's impacting small business growth from producers and suppliers. So I think from a global perspective, that's where we will see some of the challenges coming into the US. Ports is going to be another big one that we'll see that's been pushed off, certainly from an automation negotiation perspective from the unions. So from the port union, so we'll see that coming up in January, right around the time of the inauguration again. So that could cause a few more bumps, hopefully just a day or two. They're working on that now, but hopefully we'll get over that as smoothly as possible. So when we think about the impacts that this could have, certainly there's some opportunity. If we look at GDP in the US, what we've seen is a really good third quarter. Fourth quarter is shaping up to be pretty good as well. So as we're evaluating this, Gary, let's take a look at the next slide from a GDP perspective. So what you'll see is that coming in around 2.8%, we see the Fed now coming in pretty well for the fourth quarter in a very positive perspective. We expected a little bit of a slowdown following the election cycle from a GDP perspective. We still see housing as a drag on US GDP. Consumer spend is the outlier. It's what keeps pulling us along and making US exceptionalism really stand out across the regions of the world and keeps cash influx into the US to continue. So looking forward to that. I think there's some very positive momentum. If you're watching the news cycle, if we see some of the indicators that are out there, a lot of positive indicators for the US and for growth over the next few months. So that's very positive as we look forward into 2025. So if we go to the next slide, what we'll look at is investment.
Did
So
you
if we
want to
think
ask the first poll, Brody?
oh, yes, I do. Let's ask that. So when we
Let's
look at
see if
this,
they agree with us. Yeah.
yeah, let's see if you do. So if everybody can take a moment here. Will the U.S. get back to growth in 2025? I talked about some of the headwinds that we'll see, but also that U.S. Strength is going pretty well and everybody's feeling pretty good about the economy. So where do you sit? Where do you feel your company sits in the perspective of will we get back to real growth across the industry in 2025? So take a minute, click on one of the two, agree or disagree, and then we're going to bring it back around and we'll take a look to see where everybody is sitting. So Gary, how are we doing?
Got about 70%,
Great.
74% vote. Wow, good voter turnout on this one.
All right, keep
Okay.
pressing those buttons because we definitely want to see your
Yeah.
thoughts and gather it from your colleagues as well to see how others are feeling.
All right, we've got 80%. We'll close the poll. We'll share this.
All right. All right, getting back to growth, agree. And I really feel the same way as we feel this momentum coming through the holiday season. We see a lot of the indicators flashing to growth. I think we'll be very encouraged as we go forward into this year. If you guys have been watching the NFIB report that came out this morning, very encouraging numbers from there as well, pointing toward growth certainly in 2025 and the momentum that we feel right now. So let's go to the next slide, Gary. So let's think about investment. So if we see the signals that are there, we see good dollar strength across the globe for the U.S. We see that markets have been performing. I mean, the 57th high. We're really seeing some good momentum across the S&P and the Dow. We've seen Treasury yields kind of stay a little higher than we'd like them to be, but people are pulling out of cash and getting into equities, which we want to continue to feel that growth that's happening right now, that growth momentum. A lot more domestic investment here, and certainly that goes into business and supports supply chain. So we're feeling pretty good right now, even though the U.S. from an investment perspective is feeling a little overweighted. Here, the estimates are a little high, overvalued in some cases, and we saw in video kind of, even though they're making great numbers and super progress, if they're not meeting expectations, we see the market kind of pull back from them, investment pull back. And that's a challenge with just having the big seven there, is that they have to meet the growth expectations to really continue to see overall growth and investment. I think we'll be challenged with that over the next 12 months, but I think tech and AI will still be a big focus of the market as we go forward. So I think we have another poll question here, Gary, because you guys did such a great job on the first one. Let's take a look at this one. So if we feel this good momentum and investment, is your company planning to hire more employees as we think about labor going forward? Keep it net zero, not really do any new hiring unless you're backfilling, just keep it at that zero, or start to reduce for efficiency as you go forward into 2025. So get a sense of what your peers are thinking here. Go ahead and put in your selection. And then we're going to walk through some of the employment numbers that we're seeing in the US. All right, how are we doing, Gary? We getting up to 74, 75, even higher?
Yeah, we just got up to 70% here. If you've got a few more stragglers.
All right.
Okay, we'll go ahead and we'll just keep things moving along here. We'll close up the votes and share this one.
All right, so still in that cautious optimism in the middle, which is good. So as we look forward, again, I think everybody, just like me, from my opinion, I think we're sitting here looking at policies that what is policy, what is real, what is rhetoric to go forward as kind of leverage as we look at tariffs, as we look for new administrative policies that will come out over the next 3 months. we're certainly looking forward to those to make some critical decisions for 2025. But I think we're right now, from the numbers, we're on a growth trajectory. You can see here from an employment perspective, job creation, we see that picking back up. That mark that was the month before that's really low, you'll see on the left-handed chart, that's because we saw 2 hurricanes come through. We had just some challenges as some striking workers were out of work for a little while. We saw that job creation number be really low, but bouncing right back this past month. So we want to continue to monitor that as we go forward, but still pretty strong from a labor perspective. When we look at expectations for workers, for consumers, and the charts on the right tell a story about different income segments, how they feel about losing their job over the next few months, and then think about how they will think about finding a new job. So some real insights can be pulled here, as there are some challenges still from inflationary perspective, the cost of living, the worry as AI comes into the marketplace. Does that eliminate some jobs, or people just moving around at this point as the labor market tightens a little bit? But what we saw in the most recent job numbers that are coming out, even the quits rate, is that we're seeing a little bit of a rebound in job openings. And so that means that people are still in the hiring mode and not really going down into the protectionist mode as we're closing out 2024. All right, Gary, let's go to the next slide. So as we continue in our labor discussion here, I think when you think about losing or being able to capture another job as you're leaving one employer to go to the next, what you'll see here is that when we look at those that feel like they are going to be on that thin line of being able to make payments, as we look at consumer performance and sentiment, that's been improving, but we have seen some upticks here in minimum payment performance, being able to make their next minimum payment. You'll see the lower income bands going up a little bit, expecting some probability of not being able to make their payment. So we're going to continue to monitor that as we get into the first quarter. But through the third quarter, some elevation there. You can see that it pulled back a bit on consumer sentiment on the very right chart. What's been good here is the unexpected consumer, their ability to continue to spend through the cycle. Our higher income levels continue to spend. Now they've pulled back a little bit on luxury items, but they are continuing to spend across the market. That means that small businesses, certainly from the NFIB, as we look for small business optimism, we see that that continues to tick up. Which is really very positive. And the NFIB, really the numbers, if you guys haven't looked yet today, good ones to take a look at, certainly from expectations, revenue. The survey there just had some pretty positive results coming out of November. So encourage you to take a look there. All right, let's go to the next slide. So let's talk about a few companies that we see that can oftentimes tell us how the consumer is feeling in general. Looking at Dollar Tree, certainly Walmart, so where you have customers that are going from premium products down to brand products, looking for opportunities to pick up food and different products at a lower price point. We see the market trending in that way. Inventories have been picking up a little bit here, certainly with TJ Maxx picking up their inventory expectation as they go forward into the end of the year. Their earnings showed that they're able to move that through discounts. Target expanding its discount window a little bit broader, so they can capture more of the consumer spend. Their challenge is they can't move the product as quickly as they had over past years. So we see a little bit of divergence here, certainly in a little bit more premium in Target versus a Walmart type of customer, but the customer pulling back a little bit as they're still cost conscious as we get into the end of the year, and a little concerned about what they would see as jobs slow down a little bit, They're a little more concerned about being able to pick up a job in the next month, being cautious about what they spend through the holiday season. What you'll see down at the bottom here is inflation adjusted income and spend, still around 3% for both, which is good. That's a positive growth for both income and spend. That keeps us up above net zero from an inflation perspective. People are still making a little bit more to keep up with prices, and they're still spending, which is very good for the US economy. So that strong piece keeps small businesses moving forward, and cash flow is still full enough to operate in a way that they are have the potential to grow and continue to make payments on their debts as they go forward. So just some tendencies that we see from a consumer perspective and how they're impacting some of the businesses and certainly the suppliers that and wholesalers, retailers that would sell into that same space. All right, so let's continue on. We're going to look a little bit about retail sales coming into the holiday season. So over the third quarter, pretty positive from a retail sales perspective. When we get into the fourth quarter now, it's a little slower than we'd like it to be, not around the 7 to 9%, which we would expect during the holiday season, but still around 3.5% retail growth. That means it's still growing year over year, which is good, just a little slower than we'd seen in past years. So we certainly want to see, you know, if you haven't done your Christmas shopping yet, get out there and get your Christmas shopping done. And as we get into the last part of the year, we're looking for some of those holdouts. So we get into last minute shopping to see if that increases any. But right now it's a little slower than we would like to see from previous years, growth year over year. Now, what does that mean for inventories, warehouses, warehouse space, pricing on warehouse space? We've seen some improvement in inventory. Now, one of the things that you put a little grain of salt in this one, put a pin in this when we think about inventory growth, because some businesses are looking out at the next 3 or 4 months, looking at tariff challenges, some of the things that we might see from supply chain challenges from Europe and from South China Sea, some of the limitations that we'll see on chip makers as we go forward. Certainly, NVIDIA was under some scrutiny from a monopoly perspective, not a monopoly, but really a big player across the Chinese market. So there'll be some scrutiny there as they look at supply chains and being able to support US product development as we go forward. So we see companies that are leaning in heavy to get some inventory here on shore before any of these policies are put in place. So we see some early buildup. That means more cash is tied up in inventories as we go forward. What it helps though right now from an LMI perspective is that you're building out warehouse space, you're filling up a little bit more of that. The price on warehouse is picking up a little bit, which is good for the market. Also transportation, from a transportation industry perspective, we're seeing some improvement across that industry segment as well, as more of that product is moving. And certainly from a trucking perspective, that improvement moving across the country, getting to locations, getting to warehouses as they prepare for any type of slowdown in the supply chain as we get into the next few months. So a little blip here, we may see some pullback in inventories as we get into the first quarter. But right now we see those moving along pretty strong as we're looking at kind of preparing for the next few months. All right, let's go to the next slide, Gary. All right, so let's think about small businesses. So when we're looking at small business performance in the US, one of the things that I always key in on is that we look at opportunity for small businesses to grow and form in the US. One of the things that Experian always tries to do from our Small Business Bureau is that we're trying to make these small businesses that are emerging. So mom and pop shops, if you're opening a small business, if you're leaning in and saying, all right, I want to do something a little different, you know, when you're doing those types of activities, a lot of times you want to become visible as a small business, separating out your consumer credit profile from your commercial credit profile. And that allows you to get commercial credit. Well, what we've seen post-pandemic is a real increase in small business applications. One of the good things in that is that we see a lot of growth across different regions, certainly in the South and Southwest regions. We've seen significant growth in small business coming into the market. How many of these actually create employment opportunities for others other than just being a sole prop? It's about 25%. So we're averaging 400,000 business applications a month for new business starts. You see about 100,000 of those coming into fruition, entering the market. And then just slightly less than that, looking for lending opportunities out to some of our lenders, some of you. Trade credit as well, looking for opportunities in that space. So a lot of those less than a year old, again, about 34% of the credit active population right now is less than a year old. It's a pretty big percentage. We've seen a lot of fintechs in the market kind of picking up some of the slough that's coming off, the slag that's coming off of large FIs, being able to support the market and keep that pretty open. That's been very positive from a small business perspective, because able to get these products a little bit more expensive in some cases, but able to get them easily where they couldn't get it from their larger partner. So we are seeing some growth over the past 2 months from an origination perspective. You'll see the cards trend here. We've actually seen that grow. I got some of the numbers just this morning, and so we are seeing growth in the past few months here in credit card originations. We're seeing a similar trend, a little more flat from term or an installment type of origination. So unsecured really happening first, trade and our installment a little bit slower. We have seen just the trend that you all have seen in the past of the origination amounts being a little bit lower, and that's because you have a lot more, it's a piece of the data. Having newer businesses means that you have less credit, meaning that in general, with 34% being less than a year old, you're not going to give them the same high credit limits that you would give an established business. So we are still seeing that trend in the market. Now, when we look across this growth, where are we seeing the growth? Certainly, again, you're going to see a lot more of the origination growth in the South and Southwest. Across different regions, it's a little bit different in the types of products that are being offered. But when you think about the growth that we're seeing, it's spurred on because the delinquencies have peaked for commercial, for small businesses. So what you've probably seen in the news cycle is, all right, consumer delinquencies still going up. We're going to touch on that. I'll show you a trend on that, still going in the upward direction. But as we look in the bottom left here, you'll see that commercial delinquencies have actually cooled off mid-2023. We met our peak delinquency level there. And then as we moved forward over the last year, we've seen it continue to get a little bit lower and lower, a little bit every month to pull back from a delinquency level. Consumers are still spending, and when they spend, cash flows are good, we see delinquency rates come down. And that's really good. So what's also encouraging here, as you look in the lower left in that second chart on delinquency rates, it's 60 plus. And a lot of you say, why pick 60 plus? Well, 60 plus is looking at unsecured credit, and generally at 60 days past due, unsecured credit would start to take some action against a portfolio to say, all right, it's unsecured. I really want to make sure I lock in my position on the debt. And so looking at this across several vintages over the past few years, what's encouraging here is that in 2024, we've actually had lower delinquency levels. That's that green line that you see down at the bottom. Lower delinquency levels at 60 days past due. We're seeing that same trend with 30 and 90 and charge-off, same trend in the most recent vintage. What we are starting to see in the past 2 months is we're seeing the 1 to 30 days, so a little bit more slow pay, beginning to pick up a little bit more. So we're going to watch that as we think about slow pay 30-day delinquency for small business loans, and that's happening in our unsecured products, not as much in our term loan products. So watching from a market perspective as we go forward. All right, let's look at the next slide, Gary. So I want to think, when we think about underwriting policies, we think about expansion that we're seeing in the market. We talked about the small business expansion. One of the interesting insights that I want to show you here on the left is a small business survey, NFIB, and this is one I encourage you to take a look at today because we've seen some good improvement in it. Is it a good time to expand? So over the past year, one of the themes that we've cued in on is that small businesses have really been holding. They've been in a holding pattern saying, well, inflation is high. And when inflation is high, my costs are high and my borrowing cost is high. We saw that cards for both consumer and commercial, the rates on those APRs have been up around 25 to 27% higher. So we saw a little bit more movement from unsecured into longer term loans, but still pretty low. Taking on new debt is costly at this point. So people have held off on taking on new debt. And so we've seen that growth, the growth expectation be a little low until we saw the Fed kind of start to pull back and we saw our lenders begin to open up a little bit more on credit, be a little bit looser in credit criteria, dig a little bit deeper for their own growth, but see delinquencies peak mid-2023 certainly helped that story. And you can see that on the right. So we see for both consumer and commercial products from lenders that lenders are moving in the positive direction to say we're not tightening criteria, we're not thinking about tightening criteria in the next few months. We're actually thinking about, all right, is this time for us to grow our portfolios? We see a lot of that from marketing activity in our own customers and looking for opportunities to expand product layers. Well, if you do that, what do small businesses think at that point? Well, it's time. It's time to grow. It's time for me to stretch my legs a little bit more, look at the positive trends that are happening and move it forward. So I'm certainly excited about that. You'll see that in the numbers of the survey. You're going to see a spike across growth, expansion, capital outlays. All of those are moving in the positive direction. It's the first time in 2 years I've really seen every element of the survey really move in a positive direction, which is really good. And we hear that from our customers too. Small businesses are on the point. They're feeling pretty good toward the end of the year. New administrations coming in, promises of reduction in taxes, looking at opportunities to focus more domestically. So for small businesses having the ability to pick up and grow, more support here in the US. Been pretty good over the past couple years, certainly from a support network. That's why we haven't had business closures happening at a very high rate. But we are seeing that expansion kind of come to the forefront. That green light is flashing, and so small businesses will look at the next year once we get over the hump in the next couple months here of potential policy that could go in place. If we smoothly get over the next couple months, we'll see really a growth accelerator here for small businesses. The lights really are going to be on and people are going to be running to grow and hiring should pick back up again. We should see just a bit of a boost in labor market expansion. All right, Gary, let's go to the next slide. So let's talk about what's happening across the country. So I think there are different regions that will be impacted differently by growth that we saw certainly in the third quarter. You see a couple pictures here. I always like to think about images for differentiated growth across the country. Certainly in the Northeast, a lot of tourism. We look at the ports in the Northeast as well. The Midwest, certainly farming. A few more challenges in farming this year. Certainly the cost, fuel costs have been a challenge. And then some weather events that have certainly caused this industry to have a few more challenges. We'll look at tariff and supply chain. Exports have fallen off a bit. So depending on what happens over the next 3 months, we could have another opportunity for US exports to pick up a little bit and to have some increased acceleration, which will help Midwest farmers certainly as we go forward. Tech industry in the Northeast or in the Northwest, certainly having a big, exciting time over the past year and a half with AI development. So we'll continue to watch that. When we look at Southeast, we've had 2 hurricanes, some challenges in the Southeast, some good business expansion. You'll see that certainly on the right-hand side from an origination perspective. What we'll be monitoring and what you should be monitoring too is that when we have these types of climate events in areas, you'll have a lot of small construction companies pop up. You'll have some fraudulent businesses, even Frankenstein businesses, those that were dead. Somebody else comes in and raises them back up. We've seen an increase in certainly cyber, first-party, third-party fraud in the Southeast region. So we're going to monitor that. A lot more products are being developed, certainly to get in front, certainly in the pre-JavaScript collector segment of website capture, to look at different activities. Are they bot driven that we would see from international players or even some stateside players? Can we capture some of that fraud activity right up front so they're not going through your process where you're doing some credit engagement with a fraudster? So certainly look, the Southeast is going to be one of those regions where we see great expansion of small businesses, great expansion of originations. But with that great growth, you need to be cautious, certainly that you know who you're talking to and that you have a good understanding of how they'll perform going forward. Certainly something to watch for. All right, let's take a poll here real quick. So when we think about what's coming up, what trends are you seeing in your customers as we close? We talked a little bit about delinquencies. But I want to hear from you, and I think it's good for us all to hear from our peers on this. Are your customers paying as you would expect them to pay? Are they slow paying now? I mean, some of the trends that we're seeing is that slow pay is picking up in the 1 to 30 day past due. Are they asking for new terms? Generally, that happens in recession and not generally in a standard a standard growth mode. But what are you seeing? Or do you have customers that are falling behind? So let us know. Click on the numbers, let your colleagues kind of get a sense of where we're feeling as a group here this morning. And we'll see kind of the general sentiment of how everybody's feeling as we close out the year. All right, how are we doing, Gary?
We're just coming up to 57%, 58.
Right. Great, I encourage you guys to jump in on this one because I think it's a good one to really get a sense of how the market is moving. We're seeing positive trends, but are you guys seeing the same positive trends as we are? Maybe it's a little different, and maybe we want to see if this is a leading indicator, something that we need to look at a little more closely.
Okay, I'm going to go ahead and close the poll.
All right.
And share. Interesting.
I think it is, Gary. I think we're seeing that still getting some good payment, and certainly here as we look at, almost a little more than 80% still paying pretty well. 1 to 30 slow pay, but still paying, and asking for new terms lower. It's what we would expect in a warm economy, not one that's going into a recessionary time period where people are really worried about what's going to happen in the next couple months. And we've seen that from a sentiment perspective. So really pretty positive outlook, and certainly from the experience that all of you are seeing in the regions. All right, let's go to the next slide. Let's talk a little bit about unsecured debt, what's happening there. We are seeing small business credit card utilization. I looked over the last couple months, this kind of gets us through the third quarter. As we look into the fourth quarter, we've seen small business card utilization creep up to, it's been creeping in the 31% range over the last 2 months. The last month we were up around 32%. We crossed that mark. I have 33% here. And we've talked about this before. 33% is really where we see credit scores start to be more impacted from a small business perspective. So we are seeing more balances, a little higher balances being put on cards within with the Experian portfolio. So all of the data that's being furnished to us, we're seeing the utilization creep up. We'd like to see that level off before it gets to that 33% mark, but it seems to be slowly climbing and not slowing down too much like we saw at the beginning part of 2023 and the end of 2022. So we'll continue to monitor that. Now, 90-day delinquencies, you'll see at the bottom, even though we see this utilization come up. You remember we looked at 60-day. Here's the 90-day. This is when you get into more severe derog and you're taking some action in your account management process, and you're looking for, all right, am I able to collect if this debt goes bad or the company has a challenge? What we've seen is that bankruptcies are going up from a Chapter 11 perspective. These are usually larger institutions. So we'll have to continue to monitor this from a larger institution perspective and look for those indicators for some of our larger clients and larger businesses in the U.S., more private businesses to have a challenge cash flow. And we talked about a few of those from an inventory perspective and from an earnings perspective, just in a change in consumer behavior just a few minutes ago. Now, one of the ones that I've been focusing on lately has been this sub-segment 5 trend that we've been noticing. It's been about a 41% increase just in the first 9 months of 2024. You can see from year over year, a 61% increase. What are these? So these are restructuring, bankruptcies, products, opportunities for small businesses to look at for restructuring within the courts. During the summer, it was at 7 million in assets that you could apply for a subsegment 5 and get in here. But that actually dropped down in the summer to 3 million. That took a lot of the population out of eligibility here, put them back into our standard bankruptcy process. What's nice about the subsegment 5, and certainly for some of these small asset types of small businesses, is that the process is faster. The process gets better restructuring results. Plans go in and a little bit more easily, a little more structured for a small business. And it's certainly helping some of these come out of bankruptcy in a much more positive position. Now, what's the challenge here when we see 41% increase in the last 9 months and we're seeing delinquencies still pretty low? When you think about small businesses, they'll continue to pay their bills. We have to watch them because sometimes they will just turn off the lights. Cash flow is not there in their market. They walk away, close the business. You know, you are who you are as a person forever. A business is not always who they are. Businesses can close down, open up under new names. And so we certainly watch this trend that we're seeing in this smaller segment of bankruptcy as we go forward, because we really want to know if that's increasing. It's an indicator that beyond delinquency, we are seeing challenges with closures. And remember, we have a lot of new businesses in the market. Some of those that are just getting started, just getting investment, starting to build up into their 12 to 24 month history. And some of them could be hitting up against some cash flows as consumers pull back on some of the discretionary spending that they have on the outskirts, not necessarily what their core spending on energy, food, some of the necessities that they have just coming out of their personal need. So we're going to continue to watch this, but I know there's been questions certainly from this group and beyond in some of our trade groups looking at bankruptcy trends that they're seeing beyond what you get from the court.com site, looking for other experiences and trends where we can say, all right, let's go a little deeper into what is also being tracked in the market from a very small business perspective. All right, let's go to the next slide. So we've talked a little bit about small businesses and how they've been performing. Let's talk about the consumer, because the consumer is going to feed these small businesses over the next couple months. We want to see if they're still buying products. What do originations look like? Where have we seen some improvement? Well, certainly we see improvement from an auto perspective. Remember, 2 years ago, we had no cars on the lot. A year ago, we have tons of cars on the lot. And even today, they're parked next door. Lots of cars, hard to move, with high cost, high payments. I mean, if I live here in Texas, and F-150s, the Fords are very popular. But now just to get a standard F-150, you're paying $50,000 to $60,000. Very expensive, just from what the price was even 3 years ago. So very difficult to move the metal, as they say, off the lots. So even though we're seeing some improvement in auto, we want to see some of the rates come down. We'll see some deals into the next year to move some of these product off. We'll also see some tariff increases that'll add a little bit of pressure on the auto industry as we go forward. When we think about challenges that we're seeing even outside of the US, so Germany trying to restructure their auto segment. It's not just their economy that's challenging that segment from a sales. It's also just the infrastructure that they have built there for creating the product. So I think we'll continue to see challenges both domestically and globally in auto. What's great for our construction industry is that we are seeing home mortgage, some improvement there as rates have come down a bit over the past couple months. We've seen just some growth here. It's not an explosion of growth. It's not something that's setting the market on fire, but it is some growth in mortgage. And certainly from a construction perspective, we are still seeing inventory being built. It's slowly being built because it is still expensive, and being able to move that inventory is a little slower than we would like to see, but because of the cost, but some improvement here. You'll see some HELOC improvement, cash out refi still there. I think the rates are still a little too high for too much movement, but we are seeing some improvement. That means there is still cash for small businesses to pull out. If you've ever started a small business, sometimes you'll take a home equity loan or line and start your business using that from a personal credit perspective. Right now, equity is pretty high in homes, and so consumers are using that to fulfill or create or to close some gaps in cash flow as they go forward. So it's good to see that improvement happening within the market. Delinquencies, like I talked about, you'll see 30+ days delinquent here for consumers. Still on the rise. I don't know that we've seen the peak here. I mean, this is leveling out just a little bit, still growing at a slow pace with consumers. Consumers are still spending. Their utilization is crossing that 33%. So we will see some tier movement in scores on the consumer side, but from a commercial perspective, it's very stable. So we're not seeing that same kind of movement, and it's not big movement, it's small movement. But when we see these delinquency rates go up, when we see utilization go up, consumers, you and I, will look for other ways to fill the gap. One of the things that you'll see down here to the right, we have our Clarity short-term lending bureau here at Experian. What we're seeing is some pickup in short-term lending, and you'll see a few states here in dark blue where that has increased pretty significantly over the past few months. Not all of these are because of unemployment or higher delinquency or challenges. It's just we're seeing that increase. Consumers are still trying to spend like they did last year through the holidays, and I think there's a little bit of pickup here because of this resonating noise that we see from the consumer wanting to continue this unusual spend behavior. All right, let's go to the next slide, Gary.
Actually, we've got one final poll.
So
based on what you heard from Brody here, how are you feeling?
What do you guys think? So 2025, is our economy going to be warming, neutral and cool with some of the challenges that we see out there, or even cooling down a little bit as we go forward? Will the economy slow down? Will we feel some pressure from some of the global economies being challenged and from tariff activity? I don't know. What do you guys think? Is the Fed going to cut a couple more times or hold it steady? Let's see how you guys are feeling.
Got a few more stragglers.
Okay. All right.
We'll draw the line here, try and get 75% participation.
Great.
Okay.
Warming.
Well,
Warming or neutral? That's very
yeah.
interesting, huh, Gary, when we look at this, because one of the side discussions that always happens in the markets is, all right, if the Fed's going to go forward and Powell's looking at what's happening, we see this warming effect. He's still cutting rates while it's warming. There's other indicators there. It's not just that you would hold up because of the warm. But the question keeps being asked, would we expect some rates to rise here in the next year? Always the answer is no, they'll continue to move in the direction that they're moving. They've kept it pretty stable. So we should continue to see a warm economy going into the next year. So I think that's a very positive sign. And again, why we're seeing small businesses look at expectations for growth and positive movement in the next year. So again, CPI comes out, I think, tomorrow. What you're seeing is around 3%. When we look at CPE coming out too, which is really what the Fed focuses in on, it's been around 2.6, 2.8%. It's hard to get it down to the 2% that the Fed really wants it to be at, and that's because we still have a housing challenge where inflation rates are still high from a housing perspective. When you look at the dot plot, who doesn't like a good dot plot? So dot plot over the next couple years shows the Fed's continuing to trend down as we look at rate and the federal funds rate. We see it continue to come down over the next year. It may slow a little bit, but from current conditions and from the data that's available now, the direction is to continue. The Fed will continue to cut through the next year, just probably at a slower pace and depending on how warm our economy here in the US gets. All right, let's go to the next slide, Gary. So we continue to look at rates. We'll look at how consumers are transforming, looking at their lives and saying, all right, I'm ready to start a small business. This is how we look at it. If you ever wondered how Experian thought about consumers, being the consumer bureau, wanting to get consumers to go in, open small businesses where a lot of wealth is generated, we look at opportunities to do that, and we want to make small businesses visible. It's really our mission to do that. So as you follow us over the next year, we look out beyond this third quarter that we've seen in 2024. We see the positive signs through 2024 and the fourth quarter, and we look forward into the future. I think the thing that we're excited about is small business growth is still expanding, and we still are looking for opportunities to shine a light on the credit desert and look for opportunities for us to support small businesses in getting lower cost funding and helping you do it. Makes you profitable to get in with some of these businesses as they're starting fresh and get that longevity, that loyalty cycle that goes through the length of their operating, and as they go forward, a legacy customer that is profitable. So Gary, let's wrap this up and we'll talk about what we're seeing. So as we look out in the economy, I'm feeling the same thing as you are, warming through as we close out 2024. I think it's going to warm through 2025 as well. When we look at some of the cabinet positions to fill, it's still one of the things that we'll be monitoring, looking for the policies as they come out. We still see consumers splurge spending. That's some of the short-term lending that we're seeing out there is to support that splurge spending as we go forward and to cover some of the costs, certainly in the lower income segments that are tighter as prices continue to rise. We'll see some of that tighten up. There was a peak in small business delinquency in 2023. That's great for us. That means that credit markets can continue to open up. And for those of you that are lenders, trade creditors, get back into the market and expand the use into some segments that you just haven't touched on in a while. So some good growth opportunity. We continue to see a holiday push, again, between 3.5% and 4% growth in retail sales as we close out the year, which is good. Not fantastic, but good. You guys should be encouraged that consumers are still spending and the supply chains are flowing. And we're kind of in a good spot right now closing out the year. Now, we do see some oversight coming in. CFPB, other agencies are putting things in before the administration change just to get them on the docket, get them being seen, get some questions answered as we move forward and see what the new administration will bring with it. Challenges and then tailwinds as well, as we look for the US still being strong from a global perspective, more investment coming into the US than we see in other parts of the world because we're a safe haven, certainly for investment at this point. So feeling pretty positive as we get into the next few months. And I hope you guys feel the same way and certainly are warmed as we get into this holiday season that we're doing pretty good, All right, Gary, were there any questions that we have before we close out today?
No, unfortunately, we didn't have any time for questions this time, but we do hope that your this quarterly business credit review has lived up to your expectations. We would really greatly appreciate your feedback after we conclude the webinar, so please complete our short exit survey. It really does help us improve the quality of these reviews. And we also really like a lot of the feedback that we get in there, the comments about topics that we should touch on and include. So please take a moment to do that when you exit. If you would like to explore insights on small business a little bit more by talking with Experian, talking about that 2025 strategy, maybe getting back to growth with Experian, we can help you with that. You can reach out to us at experian.com/commercial and we'll connect you with the right experts. Brody and I would like to close by sending you our very best wishes for the holidays and the new year, and we look forward to seeing you again in the new year for the Q4 quarterly business credit review on March 4th. Happy holidays, everyone.